12 interest rate increases, stubbornly high inflation, and economic challenges are causing some commentators to wonder, are we going to fall into a recession? Now, in this week's Property Insider video, Dr. Andrew Wilson and I will be explaining what's happening with inflation, our economy, our rental markets, and our housing markets. So if you want to keep up to date with what's happening in real estate, subscribe to this YouTube channel. Why not join the many others who've subscribed and click the little bell icon so we can let you know each time a new show comes out. Twelve interest rate rises, stubbornly high inflation, a wages decision that risks a wage price spiral, and new economic data suggesting Australia's economic growth has all but come to a standstill. So you can understand why some commentators are increasingly worried of the prospect of a recession later this year or early next year. But despite this, our housing markets have remained stubbornly resistant with rising house prices and skyrocketing rents. So to better understand what all these trends mean for the future of our economy and our housing markets, I'm looking forward to my weekly Property Insiders chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael. And right in the middle of June now, and onwards and upwards. And we've had that latest, as you mentioned, GDP data. It is very backward looking, March quarter. A lot's changed since then, and there are some issues with the actual measurement process, which I think is actually an issue with most of what the ABS is doing at the moment. They're sort of upfront about it, about their seasonal adjustment models.
Well, all these factors highlight how delicately balanced Australia's economy is, especially if the Reserve Bank and the decision makers can't rely on the data coming to them. It seems like there's no easy answer, and boy, there's no consensus amongst commentators, is there, Andrew?
Well, there never usually is. There's always that temptation to go with the heavy-duty headline, if you know what I mean. Always attracts attention, the negativity. But and there's always fertile ground for that. We've seen plenty of changes to doom and gloom forecasts over the last year, well, over the last 5 years, really. But they persist, and the media is drawn to it like a moth to a flame because they can't resist the potential for clickbait.
Well, we can't start without talking about the interest rate rise, the 12th in a row now since May 2022. But there are signs that the economy is finally starting to feel the pinch from these higher rates, Andrew.
I thought it would be a closer decision than the narrative has sort of revealed, the commentary that was released by the governor on the day. But yeah, look, another rise, 12 increases since May last year. This is unprecedented in terms of the number of rises over the period of time. We need to take a bit of a cold shower and put these things in context, Michael. We started at zero, and we're still the best part of a percentage point below our previous peak, which in the previous peaking cycle for rates, which was at the end of 2011 into 2012. So in real terms, the actual interest rate is still at significantly low levels compared to the historical averages. But nonetheless, people work around those numbers as they are in real time today. So we can't be just saying that don't worry about it. It's below where it has been historically. But look, another interest rate increase. I thought the decision might be a bit of a line ball decision. We did have those early signs, which we've discussed as you mentioned, the economy might be finally feeling the effects of those higher rates. We certainly had a weaker labour market and retail sales over April. So if you were looking to pause, that was at least a justification for it. Of course, it was only 1 month's data. And we need to see a trend emerging before we can, really say that higher rates are impacting the economy. But let's remember the Reserve Bank did pause rates over April. You sort of thought the bias was already there, that they wanted to pause as soon as they got some substantiation that was appropriate. But they've bounced back hard again in May and now following up in June. But of course, if that weakening trend continues, the RBA is likely to pause rates sooner rather than later. However, they're more adamant about inflation being the key, Mike. We could just quote what the commentary was on the day the rate was released. The governor said inflation has passed its peak, but at 7%, still too high, and it'll be some time yet before it's back to the target range, which, remembering, is 2 to 3%. This further increase in interest rates, that's the June increase, is to provide greater confidence that inflation will return to target within a reasonable time frame. I think the commentary now is reflecting that they're very now serious, or more serious, about inflation falling. Again, the governor mentioned it, the recent data indicates that the upside risks to the inflation outlook have increased. And while goods price inflation is slowing, services price inflation is still very high and proving to be very persistent overseas. And this is something that we've consistently discussed, Michael, here nearly the last 6 months. But the Reserve Bank is acknowledging the problems with services price inflation that tends to be driven by higher prices, which of course then higher prices would then have to cover with more higher prices. So we get into that spiral environment. And we're seeing that in the US and the UK. And the governor also mentioned that unit labour costs are also rising briskly, with productivity growth remaining subdued. And that's the issue. I mean, it's all right to get your wage rise as long as you can justify it in terms of improved performance. But if your wages are rising and your performance is not rising also, then that means something has to give to maintain profitability from employers, Michael. And the result of that, of course, is higher prices to cover those higher labour costs. And until productivity matches higher wages, we're going to get higher inflation as a result. So that's the gist of the Reserve Bank has hardened up its attitude towards inflation, Michael. I think that it's now perhaps more concerned about particularly service costs increase or service price increases. And it's looking like it's actually become a lot more bearish in terms of the outlook for interest rates. And as I said, it's a little flip-flop again. 1 month they're dovish and the next minute they're bearish. And as I said, if we get another month when the May results come out for unemployment and retail sales, if again they're showing us that there's some easing going on. And let's remember the easing, let's not get too carried away. It's still very, very strong, retail sales and the labour market. But it certainly starts to justify the fact that the end may be in sight for interest rate increases. But no sign of that in the commentary from the Reserve Bank. They are clear that inflation is the dragon and that they're prepared to slay it at whatever cost it is in terms of higher interest rates.
Well, they were very firm in their commentary, weren't they? They're giving lots of information, but a lot of it's quite backward looking. And one of the sets of information that came in, our GDP, our gross domestic product, how our economy is performing, that came in lower. But Andrew, that was for the March quarter, which is January, February, March. How can you act on that in June?
Well, that's right. And I'm not sure it has a lot of relevance for a number of factors. Of course, Michael, as you're suggesting correctly, it is backward looking. But we are starting in the data. There's clearly impacts from the adjustment from the COVID lockdown period. We're seeing issues in terms of the relationship between exports and imports that are changing because we're now seeing supply match demand. All those supply roadblocks are starting to ease. So we're seeing imports increasing as a result of that, of course, because we don't have the supply constraints. We also saw exports increasing, but not at the same rate. So that took away from GDP. So what I'm saying is there's some adjustment issues here that we need to realise are unique. And we need to take these GDP numbers with a grain of salt. Some of the other factors, though, that are more relevant, I guess, to our real-term environment is that the savings ratio has fallen to 3.7%, which is the lowest since the June quarter 2008. Now, I'm not surprised that has come from a very high level. There are certainly increased costs for households now, with higher interest rates and inflation clearly tapping into savings, and now that savings ratio has fallen. But on positive side, business investment was higher over the March quarter, equipment purchases up 6%. But I think it's important to also understand, and this was mentioned by the ABS, that they're still having issues with the seasonal adjustment models. That obviously that was all turned upside down during COVID. We had months that are normally adjusted downwards because they're quieter, being the stronger months during the period because they were non-lockdown months, and the other way we saw weaker months that were lockdown months, which are typically stronger months. So it's going to take some time for that seasonal adjustment models match the longer term nature of timelines, months that are weaker or stronger accordingly. So we have to get back to normal, Michael, before those seasonal adjustment models get back to normal. So 0.2% GDP up over the quarter, the lowest result that we've had since the lockdown periods. But once again, there's a lot of ifs and buts and maybes about that. And I think the big picture is, and of course it's almost an irresistible temptation for those commentators looking for some clickbait to mention the word recession. With a 3.7% unemployment rate, to be talking about a recession is only really a numbers issue, because the real economy, and that's having a job and having a wage increase, and yes, you're struggling to make ends meet, but you're still employed, is reasonably irrelevant if we get a technically measured recession, Michael. Let's remember the only real recession we've had back in the early 90s, we had unemployment rate over 10%. So that puts it in a bit more context. And that's why, of course, it had a significant effect on households with all those people unemployed.
Sure. Now, every month, My Housing Market brings out their monthly house price indices, and we know that house prices have gone up. And mid-month, we tend to talk about your rental report. And boy, rents are skyrocketing around Australia, Andrew.
Yep, that is correct, Michael, but we've been saying that for quite some time, haven't we? Rents have risen again over May. It follows really a non-stop upward surge in rents. Everybody recognises that now, but we've really been discussing this and revealing this for quite some time. May was no relief. Again, we saw rents rising. The issue with results for May, Michael, is it comes off the back of the April results, which typically April, of course, is a significant holiday month, Easter, Anzac Day, and tenants and landlords tend to be distracted during that month because of the holiday season. So we do tend to see vacancy rates higher over April, only because of that distraction. We did see vacancy rates higher over April, but only marginally higher, but we did see rents continuing to rise. And into May, no surprise, we've seen really a very steep decline in vacancy rates for houses. Capitals recorded sharply lower vacancy rates over May, with the exception of Hobart, which was up marginally. But we also saw more rent increases. Sydney up 3.4% over the month for houses, Sydney to $750 a week. Brisbane up 0.8%, and Perth up 2.1%. Brisbane up 0.8%, Adelaide 0.5%. The year on year is a nightmare when we look at the comparisons. And for houses, it's been more of a steady environment rather than one driven by a change in migration patterns, except for Brisbane, which of course its rents are up 33.7% for houses over the past year, and that reflects that surge out of the southern states into Brisbane through lockdown. But yeah, look, it's still a nightmare for tenants. Michael, no relief in sight. Unit market, similarly, we saw Melbourne units up 6.8% over the month. Melbourne is still at the better end of affordability, but rising sharply now. And when we look at and Sydney was also up 3.4%. Sydney house and unit rents, Michael, are now matching each other and continuing to climb. And as with houses, vacancy rates fell sharply everywhere except Hobart over May compared to April. And these vacancy rate numbers are very, very low. 1% is looking like a significant vacancy rate, given how these numbers are pushing down towards almost zero. But when we look at the annual results, Sydney and Melbourne, Sydney up 38.9% for unit rents. Of course, we need to acknowledge that they were very low last year, Sydney and in Melbourne, unit rents, which specifically reflected what was happening in the city rental markets for units as a result of lockdowns and other factors such as the surge in supply over past years. But that's all behind us now. Melbourne up 6.8%, really catching up with what it missed out on, I guess, through that COVID period as well. So no relief there for tenants, unfortunately, Michael, going forward. Perhaps there's some joy to some degree for landlords because there is potential there to recover higher interest rate costs on their mortgages with higher rents. But landlords are still doing it tough. Investors are still doing it tough, trying to absorb these increases in interest rates, in mortgage interest rates.
Not only interest rates, Andrew, land tax and
Yes.
government interference, which is scaring off a lot of landlords. All that means is there's no end in sight for this because there isn't new supply coming, yet as we keep mentioning, there's increasing demand from people coming from overseas, temporary as well as permanent residents.
Yeah, I'm not sure about, there's been some chat about an exodus of landlords out of the market. Seems a little illogical to me because we would have empty houses everywhere, wouldn't we, Michael? Because we're certainly seeing prices rise now. We haven't seen any exponential growth in first home buyer activity, which you would expect to be taking up those properties if landlords were bailing out. And most of the activity in the market now, or greater proportion of the activity in the market, is coming from higher price, lower yielding suburbs in Sydney and Melbourne. I don't doubt that landlords are doing it tough, but the problem is, where do they put their money and the costs that are involved in terms of transaction costs to move out of property. Of course, they may have a lease that they've got to wait on as well. But and we're in an environment where prices are clearly rising across the board, particularly in Melbourne and Sydney. And as we've just seen, rents are going through the roof. So at least landlords have a little bit of breathing space, perhaps, with higher prices and higher rents. And certainly it'd be the last thing you'd be thinking of doing right at the moment to almost shoot yourself in the foot and get out of your rental property. And the question is, where do you put your money?
Well, your arguments are very logical. The problem is sometimes logic gets left behind when Emotions take hold, but my suggestion is don't make 30-year investment decisions made on the last 30 minutes of news or even the last 30 days of news, because the long-term trend is upwards, isn't it? Andrew, one of the other things that you keep track of is home loans, because that's usually a good leading indicator, an indication of how people are feeling. Are they going to be getting into the market? Now, again, we only got April's figures recently, so it's backward looking, but home loans eased after 3 consecutive months of increases.
Yeah, look, I have some questions about this data again. It is about the seasonal adjustment. We had a very, very strong rise over March, and then we've had a weakening over April. Now, perhaps you would expect that because of the seasonal factors, March, and we've mentioned those the holiday distractions of April, but that's supposed to be accounted for, Michael, with the seasonal adjustment models. And what I think is, again, and the ABS acknowledges this is another impact of the seasonal adjustment process, which is not working or not working efficiently because of what happened through COVID. So let's wait and see the next month's data when May data comes out, Michael. It just looks a little volatile to me, the last 2 results. And I think that there's some issues, which the ABS concedes, with their seasonal adjustment modelling, which is just creating a little bit of this volatility over recent months, that sort of April-May relationship. But it is what it is. And there was a consistency also with home loans falling for first home buyers, owner-occupiers and investors over that period. And again, it's a little counterintuitive when we look at other factors in the market over April, where we've definitely seen strong activity in our housing markets over April and strengthening activity over April. So it's just a little illogical, although the lending process can, not obviously in real time match what we're seeing in terms of sales. But like I said, I'd take it with a grain of salt, these numbers.
I just wanted to interrupt this week's Property Insider chat to remind you this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat with you to help you take advantage of the new property cycle. If you think about it, an opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and your options? Remember, we've got no properties for sale, but we offer strategic advice to give you directions, results and certainty. This is the right time to get all your ducks in a row and get set for the opportunities that are going to abound. But be careful. Property investment is a process. It's not an event. So you can't just go off and buy any property and hope to be successful. Formulating a plan and getting the right advice is more critical than ever now. So why not have a chat with the team at Metropole? Go to metropole.com.au. Now, every weekend you report the auction results in great depth, and if people want to keep up to date, they should go to your LinkedIn profile, where every Sunday morning you report them in detail. We also report them on Property Update. Last weekend was a bit unusual because there was a long weekend in a number of the states. It's funny that we have the monarch's birthday in different times in different states, but the 2 big auction capitals had a long weekend, Andrew.
Yes, they did, and no surprise, numbers were well down. Of course, agents avoid the clash with the long weekend, and we do see fewer auctions occurring over those holiday periods. But Sydney down 354 auctions in Sydney, which was lower than a year ago. But we know that numbers were just coming off what were record peaks a year ago through that boom and post-COVID period. But Sydney recorded another very encouraging clearance rate for sellers, 77%. Obviously down from that spectacular 82.3% recorded the weekend before, but no surprise in a sense, because particularly higher priced properties were vacant in the marketplace over that long weekend, is what we typically see. Melbourne, just really a handful of auctions, 253 auctions in Melbourne. Michael, clearance rate well down, but again, it's not really representative of the full market, but still a 70% clearance rate, Michael. Good result with only just 250 auctions conducted, Michael, which was, 400 auctions fewer than the weekend before. Brisbane down, and Brisbane actually had a higher clearance rate. It's really positive signs about that Brisbane market, particularly through the auction clearance rates of the last month or so, Michael. Certainly picked up, and I think Brisbane's had a very shallow adjustment period after that spectacular boom that it had, driven by that, particularly by the migration out of the southern states. Adelaide lower. Again, it was around about half the number of auctions that had the weekend before. Again, we need to take that with some sense of the holiday distractions. and Canberra also down, but just a handful, literally a handful of auctions in Canberra. Not a lot of them were reported. 54.4% clearance rate in Canberra, which is where it was until it started its revival around about a month ago. But when we look at the long-term relationship between now and a year ago, Sydney's tracking 20% higher than it was a year ago, Michael, 20%. So far in June, its clearance rate is 80.4%. It was 60.8% over June last year in a fading market. Similarly, in Melbourne, it's at 76% currently compared to 63% last year. Brisbane also is higher than a year ago, 70% versus 67%. And Canberra, even though it had that weaker result on the weekend, is higher by compared to where it was a year ago, 68% versus 60%. And Adelaide, very consistent about it. It's higher than where it was a year ago, but 82% versus 80%. So holiday weekend, we resume this coming weekend, Michael. I don't know if we're at full strength. I think we've got school holidays coming up, haven't we? More distractions coming along. And really, we've only got 2 or 3 weekends left until the market does really go on into holiday mode. And that's like a month-long or more, 2 months-long holiday hiatus that is coming forward. But it can certainly rest on its laurels, given the results that we've had over the autumn selling season. A rising market and boom time clearance rates in Sydney and nearly there in Melbourne.
Well, as we started to say at the beginning, there are so many factors affecting consumer confidence at the moment and our property market. So I look forward to catching up with you each week and helping dissect them and help people understand. See you next week, Andrew.
Thanks, Michael.